My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you, so call me at 1-800-743-CNBC. Tweet me, Jim Cramer. I know bonds are the most boring subject imaginable, but the bond market matters. Bond yields have been going up like mad ever since the Fed cut rates last month. The opposite of what you'd expect, and the velocity of the move is so fast that the stock market can't seem to find footing. Make no mistake, bonds are behind today's ugly action in the big caps. Dow losing 344 points, the S&P declining 0.18%, and the Nasdaq actually did advance 0.27%. I won't say bonds are the only thing that matters. Others do that. That's not true, though. And there are plenty of people who already give you that bogus argument. I hear them all day. So do you. It's absurd. The stock market's had a fabulous run, even as bond yields have crept up almost the entire time. They love to ignore that glaring fact, the bears. Every day is Groundhog Day for them. They see interest rates go up higher, so they panic themselves, and they are trying to panic us. But we will not be panicked. What are the bond bears really afraid of? Let's go down the list. First, the bond bears always like to use long-term interest rates, the ones set by the bond market, as a cudgel to hammer the Fed. To them, the Fed is the be-all and end-all because Fed watching, guess what? It requires no homework whatsoever. It's not like they're figuring out if Boeing has the requisite cash flow to be in on the underwriting or if ASML is really indicative of the state of the semiconductor business. If we were talking about the NFL, these are people who've never heard of the spread. They're only picking winners on the money line, not winners giving points. I think they're ridiculous in the lack of nuance. Rates higher, blame the Fed. Rates lower, take credit yourself. But here's the simple truth. Did the Fed need to do a double rate cut, moving 50 basis points and not 25? Yes. Yes, they had to do it. If they wanted to be sure that the proverbial plane didn't crash, it was the best way to keep alive the promise of a soft landing, no landing, or a quick touchdown and fill-up. So no, Jay Powell's not a dunce or a softy. He's just doing his job responsibly. And these constant naysayers will be wrong once again. They really bother me. But because bears in the peanut gallery are never held accountable, no one will remember it. If you're them. Second, a double rate cut is supposed to be inflationary, and that's what the bond market's saying. Bonds are trading like the first cut has already reignited inflation, and that you're seeing that reflected in higher long rates. To which I say, whoa, slow down. Do you really think the reverberation from a rate cut is really that fast? Absolutely not. In fact, if long rates, meaning the 30-year, have gone up enough, what they end up doing is actually being anti-inflationary. The worst part of the inflation cycle the one that needs to be slain is housing, and higher long rates will cause housing to cool again. Not only will mortgage rates be higher, but there'll be fewer homes built. All bad for the economy. We're going to have more on this later, but heavily anti-inflationary. So if you see bond yields going up and you want to blame the Fed for stoking too much economic activity, boy, you got a painful lack of knowledge. If this is really a problem, it's a problem the bond market can solve by itself. Finally, pathetic toy bears will say that stocks can't possibly go higher if rates get hit. Higher rates, stocks must go down. I don't know. How about a 4.75% 30-year Treasury? We get to that. That's about a quarter point from here. You know what? They're going to pick that line. You're going to hear that over and over again. That's an arbitrary line, and that's a line in the sand, and they're going to stick with it and going to tell you the market's going to either go down big or crash if we pass that. Now, I am not oblivious to any of this, but I come back and I say, well, wait a second. Here's what you need to know. We are nowhere near the point where the bull can be slain by higher, longer rates. Nowhere. Stocks have soared with bond yields at these levels before. In fact, they've soared with the 30-year 5%. They've soared with the 30-year at 6%. So let's stop it with the Jeremiah ads. All they do is scare people out of some very good stocks. The stocks are companies that are doing quite well. Hey, that's why you sold NVIDIA. That's why you sold Apple. What a travesty. So why do the bond bears insist on mauling us like this? Well, some of it's related to what I call the hedge fund playbook that says when bond yields go up, you should sell stocks because historically, higher rates translate to lower stock prices. That's true, in part because the higher rates are a magnet for lower stocks. But you know what matters, what's missing from this equation? Things have changed. We have so much money coming into the market via index funds, and all that money means we don't get the same intensity of selling even when the bond market goes against us. The big buybacks, the S&P 500 index money serve as a 1-2 punch against the bears because they create a temporary stock shortage. Think about this. Buybacks take stock out of the market. S&P 500 index fund money is passive. It's sticky. They have the same impact as taking stock out of the market because index fund money rarely gets taken back. There are not a lot of sellers of index funds. Buyers, buyers, buyers. Buy. So the automatic sellers that we're used to seeing when bond yields tick higher tend not to have as much impact. Have you noticed that we're frequently down at the opening and then we rally like the NASDAQ this morning? That's because future sellers start the day betting against stocks, and when the real sellers don't materialize, they have to cover their short bets, driving the averages ever higher. It is literally a virtuous circle of short sellers not acquitted by actual sellers, which then begets buyers. This is a pattern no one is talking about, but it rings true. It rings true almost every day with some part of the market. As I said, today was NASDAQ day. So what can you do? Well, first of all, I have to suggest that you never, ever, ever buy any stock on a day when it is up big, when the stock is up big. Long rates are going higher here because too much economic activity. That's okay. You want economic activity. You don't want J-Powell to be too restrictive and crater the whole economy. When rates go higher, the sellers of the S&P 500 futures, typically short sellers, are emboldened by their Pavlovian instincts to sell. Then they knock stocks down. And that's your chance to buy them, not when they're up, when they knock them down. The great part of this is that you can buy stocks that shouldn't be down, including stocks of companies that just reported strong quarters. As long as you wait, you're likely to get lower prices, and then you can pounce. Now, maybe a lot of this has been in the back of your mind, but you didn't want to say it because the bond bears on air are so erudite, and they make you feel like an idiot. Don't let them do that to you. They're the ones with no understanding of history, not you. In fact, this S&P futures phenomena is new that I just described. It isn't in the algorithms. It is not in the hedge fund playbook. We've never had so much money flow into the market via index funds before and then sit there immobile, as if it's been crunched like a buyback. And we've almost never had so few equity offerings. So there's no new supply of any big amount. Here's the bottom line. It's an extraordinary time for the stock market. I know it's easy to say rates higher, sell stocks, rate lower, buy stocks. The only problem? It's wrong. Gregory in New York. Gregory.
Hey, Jim. Greg here. Thanks for taking my call.
Of course.
First of all, I'd like to say I appreciate all the work you do in the investment club. You and your team,
thank you.
Myself, my brother, my father were all members.
Thank you, man. I hope you like the Sunday pieces I do. Eh? They interrupt my football time. Actually, no, they interrupt my lifetime. But that's all right. I do it for you. What's going on?
So I want to talk about SLB. They ticked lower last week on a revenue miss. However, the stock overall is still trading at less than 11 times earnings. You know, that being said, there's a lot of uncertainty concerning the macroeconomic environment around it. What's your outlook on the stock, and is it a buy?
I like SLB. I actually like the conference call. They've really de-risked it. They told you all the things that are going wrong, none of the things that are going right. And I don't want to jinx anything, but I don't want to. But, you know, if there's a Middle East flare-up, that stock is going to hit. That $42 stock is going to be at 48, and you're going to make money pronto. I agree with you, and thank you for the kind words. Let's go to Ayush in New York. Ayush.
Hi, Jim. Thanks for my call. And a big booyah to you and your team.
Booyah right back at you from the team.
I appreciate that. I've been following a stock that's consistently beaten earnings, grown its membership base, diversified its financial products, and strengthened its personal loan capabilities recently. Despite its strong performance, it's still down about 60% from its all-time high. Given these fundamentals, how do you think I should trade SoFi?
Oh, just to the long side. They just got some new big money. They've got big backers. They've got a great CEO. The stock is breaking out. The short's going to have to cover. SoFi is a buy. I know it's easy to say that higher rates mean you should sell stocks, but right now that would be wrong. It's an extraordinary time for this market. Buybacks, S&P money, yes, for real. They have money tonight. Banco Santander just launched a milestone U.S. expansion in digital banking, and it kicked off by ringing the closing bell. I'm hearing more about the news from the company's top brass. You'll want to hear that story. Plus, is the rally in home builders hit its roof, or can the group actually keep heading higher after what I just described? I'm going off charts to find out, and telling you which stocks could keep leading the charge. Then American Express fell on Friday's beat and raised quarter, but is it just yet another buying opportunity? I'm carrying through the quarter and giving you my take, so stay with Cramer.
Don't Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.